Welcome to the Deep Dive. Today, we're cracking open the Q3 2025 earnings report for, well, the biggest of the big banks, JPMorgan Chase. We've got their official release, market data, analyst takes, all structured into a kind of five-part framework. Our mission really is to find the story behind the numbers. What's the real takeaway here?
And it's a fascinating story right from the get-go,
Yeah.
because you have this paradox. JPM absolutely smashed expectations. Revenue, earnings per share, both significantly better than analysts predicted. Should have been a clear win.
Well, the market didn't exactly cheer, did it?
No, not at all. That's the thing. The stock basically flatlined, actually dipped just a tiny fraction, 0.04% in pre-market trading right after the announcement on October 14th. So this deep dive, it's all about figuring out that disconnect. Great numbers, meh reaction, the tale of two narratives.
Okay, so let's follow that structured analysis from our sources to unpack this. Now for slide one, the at-a-glance scorecard. So let's nail down those headline wins first. The performance was strong. Revenue hit $46.43 billion. Consensus was, $45.6 billion. So a nice beat there.
Very comfortable beat, yeah. And earnings per share, the diluted EPS, that was even more impressive, came in at $5.07. Analysts were only looking for about $4.87.
Okay, so significantly ahead on both fronts.
Right. And analysts initially, they jumped on the strong trading results, but they couldn't ignore that stock price just sitting there. Their take pretty quickly became, the results are great, but the market's spooked by what management is saying about the future, those broader macroeconomic concerns.
The market listened more to the warning than the win, essentially.
That seems to be the case, yeah.
Okay, let's look at the year-over-year picture, JPM's internal growth. Total revenue up 8.8% to that $46.4 billion figure. Net income grew even faster, 11.6%. But the real standout was diluted EPS up 16.0% to $5.07.
It's worth pausing on why that EPS number jumped so much more. I mean, 16% growth when revenue's up just under 9%, that doesn't just happen. There are a couple of key reasons for that multiplier effect.
Okay, let's hear them.
Well, first, you've got what they call positive operating leverage. Fancy term, but basically means their revenue grew faster than their costs. Revenue up 8.8%, but non-interest expenses only climbed 7.6% to about $24.3 billion. So they got more efficient.
Right. Each dollar of revenue costs them a bit less to generate. Makes sense. But that still doesn't feel like enough for a 16% EPS jump.
You're right. It's not the whole story. The second big piece was, frankly, financial engineering. They bought back a ton of their own stock. $8.0 billion worth in net repurchases just in Q3.
Ah, the buybacks. Fewer shares outstanding means the same profit gets divided among fewer shares, boosting the per-share number.
Exactly. You shrink the denominator in the EPS calculation, and boom, the result goes up. It's a direct boost for remaining shareholders.
But hang on, if management is warning about uncertainty, like you said, is spending $8 billion on buybacks really a sign of confidence? Or is it more like, let's use this cash while our stock might be undervalued because of our own cautious talk? Seems a bit, you'll see.
That's the tension, right? It definitely raises that question. They'd argue they're performing strongly now and returning excess capital is the right move. And remember, that 16% EPS growth is diluted EPS, the more conservative number that accounts for options, restricted stock, etc. So even with that caution, the underlying mechanics were powerful.
Okay, interesting tension there. Let's move on. Moving to slide 2, the engine of profitability. All right, so beyond just profit numbers, how efficiently are they using their capital? The key metric here is return on tangible common equity, ROTCE. That improved, right? Went from 19% last year to 20% now.
So yeah, and 20% ROTCE is really, really strong. Forget the complex definition for a second. What it tells you is how much profit they're squeezing out of their core tangible capital, the stuff that actually supports the business day to day, not goodwill or intangibles. Getting to 20% and improving means they're getting even better at generating profit from their operational base.
So highly effective use of their core capital. And what about general operational efficiency?
That's reflected in the overhead ratio. They reported a firm-wide managed overhead ratio of 52%.
So using your analogy from before, it cost them 52 cents in operating expenses to make $1 in revenue.
Pretty much. And lower is better, generally. So 52% confirms that positive operating leverage we talked about. It points to a pretty tight ship operational.
Okay, quick clarification needed. They gave two revenue numbers, reported at $46.4 billion and managed at $47.1 billion. What's that $700 million difference about?
Yeah, that's mostly an internal accounting thing. The managed basis is non-GAAP. They basically adjust certain income, like from tax-free municipal bonds, to pretend it was taxed. It helps them compare performance across different business lines on an apples-to-apples, taxable equivalent basis. Doesn't change the bottom line net income, but good to know why there are two numbers.
Got it. Internal comparison tool. Makes sense. Moving to slide 3, the engine room business segment performance. All right, this is where we see which parts of the bank really drove that big earnings beat. There are 4 main segments. Where did the magic happen?
No question, it was the Commercial and Investment Bank, the CIB. I mean, this segment was on fire. Revenue jumped nearly 17% year over year to almost $20 billion, and net income up over 21% to $6.9 billion. This division single-handedly powered the overall beat against expectations.
Wow. Okay, break that CIB number down. What specifically drove that kind of growth?
Well, investment banking fees were solid, up 16%. That reflects a bit of a pickup in M&A and especially equity offerings, IPOs, and the like. But the real engine was the markets division trading, basically. Markets revenue just exploded, up 25%.
25%.
Yeah. Fixed income trading was up 21%, and equity trading was even stronger, up a massive 33%. They clearly capitalized extremely well on more active global markets during the quarter.
Okay, but a 25% surge in trading revenue, that sounds inherently, well, volatile, doesn't it? Can they count on that repeating? Or is management's talk about uncertainty sort of an admission that, yeah, this was great, but don't expect it every quarter?
That's exactly the risk profile of CIB. It can deliver these incredible results when markets are favorable, but it definitely ties their fortunes closely to global capital flows, which can turn quickly. And that really leads us nicely into the second big segment, which showed the other side of the coin, Consumer and Community Banking, or CCB.
Right, the consumer bank. Headlines looked okay there too, didn't they? Revenue up 9.5%, net income up almost 24%. Sounds healthy.
On the surface, yes. Growth was driven by more deposits, more people using their credit cards, but you have to dig a little deeper. Look at their provision for credit losses. That's the money they set aside because they expect some loans won't get paid back.
Okay.
Within that provision, they specifically added $575 million to their reserves, a net build. And $550 million of that was specifically for credit cards.
Hold on. So despite reporting good growth, they proactively tucked away over $500 million, mainly because they expect more credit card defaults down the line.
Precisely. That $575 million reserve build is the action that backs up the cautious words from management. It's a tangible signal. They are looking at the U.S. consumer, seeing the pressures, maybe inflation, higher rates, and deciding they need a bigger cushion specifically for potential trouble in their card portfolio. It's prepping for bumps ahead.
That really highlights the two narratives thing, doesn't it? Investment bank booming, consumer bank bracing.
Absolutely. Fortunately, they have a stabilizer. The third segment, Asset and Wealth Management, EWM, is just steady growth. Revenue up 11.5%, net income up nearly 23%. This is driven by fees on managing money and strong inflows of client cash. Their assets under management grew 18% to a huge $4.6 trillion. It's predictable, fee-based income that balances out the CIB volatility.
And the last one, the corporate segment.
Yeah, that showed big declines, but the sources suggest that's mostly due to internal accounting changes around how they allocate funding costs. Less indicative of the bank's core health this quarter.
Okay, let's shift gears. Moving to slide 4. Financial strength and shareholder rewards. JPM always talks about its fortress balance sheet. This quarter seems to back that up. What's the key number showing their capital strength?
It's got to be the CET1 ratio, Common Equity Tier 1. They reported it at 14.8%. Just think of CET1 as the bank's highest quality, most loss-absorbing capital buffer relative to its risky assets. And 14.8% isn't just good. It's massive, way, way above what regulators require. It's like a financial shock absorber built for a major crisis.
And despite holding so much capital, they also returned a huge amount to shareholders.
A staggering amount, yeah. $12.1 billion in total returned in just Q3.
How did that break down?
It was $4.1 billion paid out as dividends. It's $1.50 per share. And then the other $8.8 billion was those share buybacks we talked about earlier.
So returning over $12 billion while still maintaining that incredibly high 14.8% CET1 ratio, what does that combination really tell us about how management sees things?
I think it says their caution isn't about current weakness. They're clearly operating from a position of immense strength. They feel strong enough to handle potential future trouble and reward shareholders generously right now. It's like saying, we see clouds on the horizon, but our fortress is so strong we can still send supplies out.
Preparation from strength, not fear. Okay. Now for slide 5. The road ahead management's outlook and key takeaways. So let's bring it all together with CEO Jamie Dimon's comments. He said the U.S. economy is generally resilient, but then immediately pivoted to heightened degree of uncertainty. He listed geopolitics, tariffs, high asset prices, sticky inflation, the usual suspects. His mantra seems to be hope for the best, but prepare the firm for a wide range of scenarios.
And that quote perfectly captures the whole quarter, explaining that muted market reaction. So if you're trying to make sense of it all, here are the four main things to take away, the core narrative points. One, the investment bank fueled a strong beat. CIB performance, especially in trading, was exceptional and drove the headline success. But it relies on potentially volatile markets.
2. Consumer caution tempers the celebration. That $575 million reserve build in the consumer bank is the key tangible evidence backing up management's cautious outlook. They see risk there.
3. Fortress principles are on full display, returning $12.1 billion while keeping a 14.8% CET1 ratio shows immense financial strength and the capacity to both reward shareholders and prepare for storms.
And fourth, the main theme, a tale of two narratives. You had outstanding operational results, particularly from CIB, clashing directly with very cautious forward guidance. The market, it seems, weighed the caution more heavily.
Right. And maybe a final thought to leave you with. Don't just see this as a simple earnings beat. See it as the validation of JPM's long-term playbook. They use their scale and expertise to absolutely crush it when times are good, like CIB did, and then they use the profits and strength generated during those good times to proactively build defenses for potential bad times, like we saw with the CCB reserves. It's maximizing the present while rigorously preparing for an uncertain future.
Financial disclaimer. This report is for informational purposes only and does not constitute financial, investment, legal, or tax advice. All investment decisions should be made based on your own research and in consultation with a qualified financial professional. AI disclaimer. This report was generated by an artificial intelligence model, and all information should be independently verified. Like and subscribe to stockanalytics.ai YouTube channel. Members get access to our library of all S&P 500 stocks and get priority requests for company deep dives.